In this lecture, we begin to look at the macroeconomy. We will start by looking at the simple model of how the economy works and move to measuring the economy and accounting for price changes in the economy. The private sector is divided into two parts, households and firms. A household consists of one or more individuals living within a single dwelling, like a house or an apartment or a condo. There are three types of firms you should know about. They are sole proprietorships, partnerships, and corporations. Private sector is divided into two parts, households and firms. Households consist of one or more individuals living within a single dwelling, like a house, an apartment, or condo. There are three types of firms you should know about. They are sole proprietorships, partnerships, and corporations. A sole proprietorship is a business owned by an individual who is financially responsible for any losses but receives all the profits of the business. So, if an individual who is a sole proprietor loses money, her business, her creditors could take her house, her car, or any assets she has in order to pay for losses of the firm. The sole proprietor only pays taxes on the profits of the business. There are two types of partnerships, general partnerships and limited partnerships. A general partnership is a business owned by two or more individuals. All the individuals involved are financially responsible for any losses, and the profits are divided up according to the partnership agreement. Thus, if the business fails, the business's creditors can take the homes and other personal property of value from all the partners. The partners pay taxes only on the profits of the business. A limited partnership is a business owned by two or more individuals. Some of the individuals involved are financially responsible for any losses to the partnership, while others have limited liability, and the profits are divided up according to a partnership agreement. Like a general partnership, partners may only pay taxes on the profits of the business. Corporations. A for-profit corporation is a separate legal person which is controlled by one or more shareholders, whose liability is limited to the value of the money they use to buy the share of the stock. Corporations are popular because creditors can only go after the assets of the company, but not either of the employees or the stockholders. However, corporate profits are taxed twice by the government. First, the corporations are taxed on any profits they earn. After the stockholder or shareholder receives their payment in the form of dividend, they are taxed again on the dividend. Another form of the corporation is a non-profit organization or corporation, which is a legal person which is designed to give services to the community without making a profit on the activity. Many religious groups and other service organizations are non-profit corporations because it limits the liabilities of their members. International corporations are corporations owned and operated internationally. Firms are founded by individuals called entrepreneurs. Spending by households is called consumption, and spending by firms is called investment. Houseboats give firms labor, investments through financial institutions or directly, and payments for goods and services. Households receive from firms wages, payments for labor, dividends and interest, and goods and services. The government receives from the private sector labor from households, taxes from both households and laborers, and goods and services from firms. The government gives the private sector wages to households, government services to both households and to firms, and payments for goods and services to firms. Households give labor investments through financial institutions and payments for goods. Firms give households payments for interest, labor, and goods and services. The international receives exports and gives imports and receives payments for the exports to firms. Next, let's look at the national accounting. National accounting is an important part of the start of macroeconomics because it gives us a way to measure the economy. The measures help us understand whether the economy is growing or shrinking and whether individuals are better off or worse off than in the past. National accounting is a framework that summarizes and categorizes the productive activity in an economy. The measures of accounting that we'll look at in this course are GDP. There are two ways that GDP can be calculated, either as consumption, expenditure, or as income. Personal income, disposable personal income. GDP is a measure of all goods and services produced in an economy during 1 year. The assumption of the measures are, first, that we're dealing with final goods and services. This means that things that are only purchased by the end user of a good are included. For example, a car is counted as toward GDP, whereas the cost of steel in the car is not counted. The reason that the cost of steel is not counted is that it would be counted twice. For example, an economy produces a single car costing $21,000 and the steel used in it costs $6,000. The cost of the steel is part of the cost of the car. Thus, if the steel were counted in addition to the car, the steel would be counted twice. Goods used in the production of final goods and services are intermediate goods. Inventories are counted as final goods because the goods are at their final sale point. Prices are used to calculate GDP are the current market prices. The GDP figure reported by the government does not include any transactions that take place in the informal or the underground or the black market. Inventory is a stock of unsold goods. There are two types of inventories. Planned inventories, that is, those inventories which firms plan to sell in the future, and unplanned inventories, inventories which the firms don't plan at having at the end of the time period. Any unsold inventories are counted as part of GDP. Here is a graph showing the GDP as expenditure from 2000 to March 2012. The data on the graph is interesting for two reasons. First, if we break up the data into parts, we can quickly get an overview of the economic situation of the past 12 years. The years 2000 to 2008, it is clear that the economy is growing because of the continued rise in the line representing GDP. Equally clear is that there is a drastic drop in GDP between 2008 and 2009. And finally, following 2009, there's been growth in GDP. Indeed, it may be hard to believe that, but the United States has not been in a recession for almost 3 years. If GDP is calculated by looking at how money is spent, it can be divided up into 4 categories. Expenditures by households is called consumption and is represented by the letter C. Consumption by business or expenditures by business is called investment and is represented by the letter I. Expenditures by government is called government spending and is represented by the letter G. Expenditures by the foreign sector is called net exports and is defined as being exports minus imports and is represented by the letter X. Gross domestic product, or GDP, is represented by the letter Y. The formula for GDP is GDP is equal to C plus I plus G plus X. Or if we change our net exports into imports, we can represent it as GDP is equal to consumption plus investment plus government spending plus the difference between exports and imports, or exports minus imports. We can also rewrite the formula in a more traditional way using the letter Y. The simple formula for GDP using the letter Y is Y, or income, is equal to consumption plus investment plus government spending plus X. And once again, we could write the formula expressing net exports as the difference between exports and imports, or Y is equal to consumption plus imports plus government spending plus the difference between exports and imports. Let's look at some examples of the expenditure model of GDP. In our first example, the country generates $8,240 billion worth of consumption, $1,928 billion for investment. The government spends $2,215 billion, and the next exports is $500 billion. If we total all this up, we get $12,857 billion for our GDP. Let's look at another example. In our second example, the country generates for consumption $8,214 billion. Investment by firms is $1,928 billion. Government spending is $2,215 billion. And notice that our net exports is a minus $624 billion. Also notice that when we add this up, that our GDP is $11,733 billion, which is much less than if the net exports were positive. Notice the importance of net exports in the calculation of GDP. When the net export is positive, the country exports more than it imports, GDP receives a boost. When the net exports are negative, the country imports more than it exports, GDP declines. Now let's look at some real-world data. Here's a graph of gross domestic product, the black line, the personal consumption in the light blue line, investment by firms in the light blue or light green, government spending in the dark red, and net exports in the light orange. There are a few things to notice. Consumption by individuals is the largest component of GDP. For example, in 2000, consumer spending accounts for about 70% of GDP. Also, the shape of the line representing consumption tracks very closely the shape representing GDP. Investment by the private sector accounts for a small portion of GDP. Government spending as a percent of GDP is also quite small. What is troubling to some economists is that the government spending is increasing while investment by the private sector is declining. They are afraid that government spending and the associated borrowing to fund government expenditures will crowd out private investment. Finally, notice at the bottom of the graph the net exports below the zero line, telling us that net exports are negative, or the U.S. is importing more than it's exporting. Indeed, if there is a silver lining in the last couple of years, is that Americans are purchasing less goods from foreign countries. Another way to measure GDP is to calculate the income to the various sectors of the economy. When GDP is calculated using income, it is often called gross domestic income, or GDI. In theory, GDI and GDP should be identical because one person's expenditure is another person's income. The income model of GDI or GDP as income includes wages paid to labor, interest paid to households, rent for the use of land and other things, and profit. It also includes a net factor from investments abroad, which is the difference between what U.S. earns abroad and income paid to foreigners, indirect taxes, or taxes collected by firms and turned over to the government, and finally a capital consumption allowance. Depreciation is a reduction in the value of a capital good over time as a result of its use in production. And so a capital consumption allowance is depreciation plus damage to capital stock. The formula for calculating gross domestic income, or GDP, as income is wages plus interest plus rent plus profits minus net factors abroad plus capital consumption allowances plus indirect taxes. Another interesting measure is personal income. Personal income, or PDI, is defined as the sum of income earned and received in a given year plus income earned but not received in a given year plus income received but not earned in a given year. Personal income is the person's gross income, or the income before the person pays taxes. Let's take a minute to look at each of the components of personal income. Income earned and not received in a given year. This is what happens when an individual works and receives their wages before December 31st. Income earned but not received in a given year is the individual worked and earned money before December 31st but not received the wages until after December 31st. Finally, income received but not earned in a given year is a transfer payment, like unemployment benefits. This graph shows the changes in personal income between 2000 and 2011. Personal income is the measure as an aggregate, or a sum of everyone's income. So if the incomes of the rich increase at a faster rate than that of lower incomes, then there will be a general increase in what Americans are earning. The graph tells us nothing about how income is distributed in the economy. As we will see in a later lecture, the level of income inequality is measured using something called the Gini index. Also notice from 2008, personal income increased. Between 2008 and 2009, personal income went down, and after 2009, personal income increased, but not as dramatically as in the past. Disposable income is the person's personal income minus personal taxes. Disposable income is important because it tells the economist how much money individuals have to spend. Since disposable income is the income that can actually be spent by consumers, the amount of disposable income will have an impact on GDP, assuming that individuals spend their money. Higher taxes reduce the amount of disposable income and hence could reduce GDP. This depends on how the government spends its money. This graph shows the relationship between personal income, which is the light or the bright red line, disposable income, the light blue line, and the rust-colored line, personal taxes. There are several points about this graph. Personal income and personal disposable income follow each other. For example, from 2000 to 2008, both personal income and personal disposable income rose at roughly the same rate, and at 2000, both declined roughly at the same point. Notice that personal taxes declined even as personal income increases. This may be due to tax cuts by the Bush administration and an increase in home ownership. Interest on mortgages is tax deductible, which may lessen the tax burden of many individuals. Also notice that a decrease in personal income during the recession also caused a reduction in the amount of taxes paid to government.